Basically, the idea that we define artificial intelligence as that which machines can't do yet. And so rather than trying to look into a crystal ball and predict the future, we focused on thinking about what machine learning and similar capabilities like it were doing in financial services today, and how existing capabilities would be incorporated into financial models over the next 3 to 5 years. So we saw that in financial services, there were 4 areas in which machines were having a significant impact. Firstly, they were making existing processes faster and more efficient. Secondly, they were improving the capabilities of existing activities. So effectively figuring out how to better adjudicate loans, figuring out how to generate alpha in investments. Thirdly, they were creating whole new value propositions, effectively using the training data at the disposal of market utilities and the like to build out new macroeconomic predictive capabilities as a service or to offer new regtech capabilities. And then finally, what I think is really the frontier of what we're seeing right now is around creating new digital advisory and product customization functions. So I think that to date, we see that machines continue to struggle around creating customization that is understood by and easily accepted by humans. And we also see that machines tend to make some mistakes in terms of things that humans would find completely obvious. And so we really see a world in which having humans and machines operate in alignment with one another is really valuable and important. A machine might be able to identify an outperforming asset that a human might have missed, but it also might not understand the broader context of why that asset is outperforming. And so when machines and humans are put together, they're theoretically able to achieve much better outcomes than either could alone. So I think we're seeing all kinds of interesting instances in which AI is being deployed in financial services. We're seeing that greater efficiency being deployed through the application of things like machine vision in automotive claims handling. So now increasingly you can take a photo of a scratch or a dent on your car and you can have that insurance claim fulfilled and paid within a couple of days. We're also seeing really interesting instances of it being used to improve product capabilities. So think about credit adjudication. Until very recently, it's often been difficult for new immigrants to a place to acquire credit there because they don't have the established history in the typical databases. We're seeing all kinds of organizations looking to gather new signals about an individual's creditworthiness or to pull signals from their past life that help you make a strong credit decision. And then we're seeing really interesting instances even of third parties starting to make a play based on AI into the financial services space. Think about the role that Amazon plays. Amazon has these new stores now where you can walk in and pick a product off a shelf and walk right out. This is effectively a new entry into the world of payments and merchant acquisition built off the back of machine vision. Similarly, you're also seeing Amazon using things like their natural language processing and their speech recognition capabilities through their smart speakers as a new mechanism for clients to interact with their financial institution. And so we're seeing machine learning and AI becoming a core part of almost every aspect of financial services. Financial institutions are obviously extremely interested in the opportunity that AI presents for them to improve their existing business offerings and to reinvent their established ones. But they face a really significant challenge in terms of doing that has nothing to do with their commitment to the idea of AI and new tech, and everything, ironically, to do with the fact that they've been in the tech business for so long. Incumbent financial institutions have legacy mainframes that are sometimes 40, even 50 years old. And while they have vast quantities of data, that data is typically trapped in individual product silos. And in order to be useful for AI, it really needs to be brought together. All of these disparate pieces of information about an individual's varied holdings need to be brought together into a single place to train an algorithm that'll let you make better decisions or customized advice for that individual. And so that's really the challenge that financial institutions face today, is how can we take the existing resources that we have and modernize them in a way that lets us serve customers in the way that we want to. I think private banks are in a really interesting position vis-a-vis the use of AI. AI benefits from data sets that aren't just deep. It's not just about having 30 or 40 years of checking account data, but that are broad and where the customers are differentiated from one another. I mean, that's really where customization can most effectively be brought to bear. And I think the really heterogeneous nature of clients that private banking has puts them in a position to focus on creating some really interesting and differentiated value propositions for those players. At the same time, the smaller size of private banks potentially makes them more agile in terms of responding, particularly when they're willing to integrate with best-of-breed providers and not necessarily do everything in-house by themselves. So I think there's a really interesting set of opportunities that exist for those type of institutions.